Hi and welcome to Humble Loans. Well, today we're going to look at a topic called mortgage stress. We're going to look at what is mortgage stress, how does it occur, and what can we actually be doing about it. Well, it's commonly understood that mortgage stress is when a household's spending is more than 30% just on the home loan repayments itself. And when this starts to happen, households can start to sacrifice on a lot of different things in their life just to keep the dream of home ownership alive. And I've seen this firsthand twice throughout 2009, 2010, and then again in 2013, 2014. So it kind of goes in a cycle, but this one is a little different to the last two that we've actually seen. Over the longer term, that sort of pressure and the pressure of making these sort of sacrifices, and for some households, those sacrifices are quite drastic. That sort of pressure can actually have quite a long lasting physical, psychological, social, or even emotional consequences on their life. You just take the average family. For some families, they're being pulled out of private schools and children are being taken out of schools that they've been in for 5, 6, 7 years and having to go to public schools so that the family can actually pull back 15 to 20,000 of those dollars per year and put it towards the home loan. That will have a lasting impact on those children as they get older. They'll not forget that. Now, for some children, that'll be a benefit to them to understand that they can make changes in their life. But some children, it does make quite a big, significant impact on their life when their friendship groups have been removed. So, while the current mortgage stress environment has been prompted by a series of interest rate rises, people are now starting to feel the stress of their mortgage due to the inflationary pressures of the cost of living. And that's where the difference of this round of mortgage stress differs from the GFC mortgage stress, which we saw a lot of people experience, but that was solely around interest rates. This one is a double whammy. This is interest rates and cost of living expenses rising and rising and rising. I mean, for instance, I was just at the petrol bowser yesterday. $2.30 a litre. I couldn't believe it. Only a year ago, I was thinking, my goodness, if we're at $2, and I'm starting to think now, when are we going to be at $3? And that's $110 to fill a 50-litre tank now. It takes you right back to when you first get your driver's license. Petrol used to be 60 cents a litre when I first got my license. My goodness. So no matter what proportion of income is actually being spent on repayments, if it's a struggle for these people to actually meet their obligations, and that can be coming from job losses, rising expenses, change in living arrangements, or anything else, the end result is still going to be the same for these mortgage holders, and that's mortgage stress. The mortgage is the thing that creates so much stress in people's lives that have home loans, because it's the one thing they want to hold on to the most. You'll find people who have car loans and they get under financial pressure. They just sell the car. They get rid of the car, get rid of the loan. But when it comes to the home, a lot of people don't want to let go of that home, which is sometimes something that they should actually do straight away before things get out of control. But it's a lot harder to release a house than it is to release a car emotionally. So it's interesting to note the statistic. Just a little statistic here. The RBA has actually revealed that up to half of the borrowers with high to low income ratios, that's where they've borrowed right up to the absolute maximum amount that they can actually afford pre rate rises, and now where the rate rises have been almost 2-3 times what they borrowed at. They may not actually have enough income to cover their current household costs, and it's necessary because within 25 to 50% of these high to low income ratios, they don't even have enough money to cover their minimum living expenses. So that's where the pressure is really going to start to hurt. And a lot of these people have been on those very low fixed rate mortgages, which have been coming off. Still, there's another 100,000, I think, in Australia to come off between now and the end of the year, but a lot of them have. And when they come off, it usually takes about 3 months after being on those low fixed rates before the stress really starts to hit. Some households are finding it increasingly difficult to cut back on further living expenses as they've already started to reduce or have already reduced in a lot of these areas, and they've shortened up their budgets as much as they possibly can. However, the RBA has actually added that most borrowers have been able to adjust their finances throughout this period by restraining their living expenses, spending, reducing their savings rates, or even drawing down on some of their savings. And we have seen a lot of that in the industry. A lot of people have been drawing down on their savings in order to keep up with their loan repayments, because it is cyclical. There will come a time when rates will start to drop, so they're just trying to manage their way through that period, which is a fantastic thing to do if they had savings. But for a lot of the people, they never actually had the savings in the first place when we started to raise interest rates, and that's where the pressure really starts to hit a lot of these households. So, what do we do about it? Well, if you're looking to reduce your monthly living expenses in the shorter term, then a potential strategy is actually to look at restructuring your loan facilities. And that goes across all your loan facilities, any form of credit or debt facility. You want to sit down and have a good look at how to restructure it. So for a lot of people we found that have had home loans for 5 or 6 years, or they have been under a little bit of stress because they've gone from 3.5% down to that 2% and then rode up to, high 5s, early 6%. Restructuring a mortgage can actually recover some of the minimum loan repayments. So just to break it down, they would have been 20 years to run, but still on a 30-year home loan. By resetting that mortgage in the shorter term, it's going to lower their monthly repayment. Therefore, they can go into that minimum monthly repayment for the shorter term, get through this period, and then increase their monthly repayments as they go forward. And that will help them get back on track. But in the short term, it doesn't mean they're having to make drastic living expenses and financial changes in their life. So in fact, new data actually reveals that almost and I was shocked when I read this, that 1 in 3 mortgage holders have never actually refinanced their loans despite having a mortgage for more than 10 years. Now, that's actually a good thing, mind you. If a mortgage holder has not restructured their loan for 10 years, hats off to you. That's fantastic, because that means you've only got 20 years on your home loan to go, or less if you've been making more repayments. So that's a fantastic thing. But if you are finding it stressful and things are tight and you've made as many changes as you possibly can, and you've had a home loan for 3, 4, 5, 6, 10 years, then it is wise to look at restructuring that in the short term. So I hope that serves you well. I hope that information helps you. And if you know anyone that has or is undergoing some form of mortgage stress, just give them my details, email below, phone number here. Let them know, or share this email and let them know that there are more than just cutting back on living expenses. There's more than just that. They can look at a variety of different ways in order to get through this. So have an awesome day, and I'll talk to you next week.